Hey, and we got a good topic today. I want to say this though, not all loan programs are created equal. And choosing the wrong one could cost you thousands of dollars. Okay. The right loan is not about what's popular, it's about what fits you. So, guys, we want to talk about that today because it's so important that you have the right loan program that fits you. And we're going to dig in deep with that. So, I'm going to jump right into it. So, guys, I got my professionals on here, my loan officers, my mortgage professionals. I want y'all to answer this question. Can you give us a quick breakdown of what are the main differences between FHA loans, conventional loans, and VA loans for the people?
Yeah, so I mean, for the most part, they all are, the similarities that they have, or that is that they all are mortgage products that you can use to buy a house. So what makes them different when it comes to credit, when it comes to down payment, and then sometimes the mortgage insurance. Those are kind of the three big buckets of the
Mhm.
differences between those three types of loans. So starting with FHA, the down payment on that is standard. It's fixed at 3.5%. A lot of first-time home buyers love that program,
Mhm.
specifically because you only kind of have that one option of the 3.5% as the down payment. When you go over to talk about conventional, that one has a lot more flexibility, whether you're going to use it as your primary, second home, or an investment property. So usually a lot of people don't know if you're a first time home buyer going conventional, you can put down as little as 3%. So it kind of comes in a little better than FHA when it comes to the down payment requirements. And then last but
Mhm.
not least, for those who are eligible, whether you are current active duty military or retired veteran, VA provides the no down payment option, and it has lots of flexibility when it comes to credit and things like that. So, just in a quick summary, less than a minute little nutshell, that's kind of some of the major differences of those three loan types.
Well, let me ask this question.
Mhm.
I do see a lot of FHA loans. Is that one of your most popular ones that you do a lot, or kind of which ones do you do the most of, if I must ask?
Yeah, I mean, I think I would say for the clientele that we serve, um, FHA would probably be our most popular
Mm,
loan type that we use. A lot of people, when you think of conventional, you think of high credit scores. We're talking 680, 700s and better, um, and not everybody carries a 700 to 800 credit score. So
right,
sometimes
right.
to qualify for the better interest rate, or just to put down the only 3.5%. A lot of our first time home buyers who have scores in the 600s, um, and or looking for various different programs that gives down payment assistance, things of that sort. FHA is the better route for them,
Mm,
because not only we'll get into it, but not only does FHA allow for 3.5% down, it also allows borrowers to borrow more money. So we're going to get into what we call debt to income requirements, where it allows your debt to income ratio to go up as high as 57%, as opposed to a conventional loan, which may be capped at 50%. But we'll dive deeper into that. But to answer your question, yeah, majority of the loans um, we pre-approve our clients with, or we close with, are majority FHA.
right. So, I kind of talked about this one time. I did a video on this. Like, if I had to start over, right? If I was going to buy a home in 2026, guys, one of the first things I would do is, hey, understand what loan program best fit me. Okay.
Right.
My situation, you can't look at John and what loan John had. You can't do a lot of comparisons because everybody's situation is different. Okay. Some people have more debt than others. Some people have higher credit scores than others. So don't look at someone else's situation and say, hey, I want the same thing they got. You might find something better for you that fits you and your situation, right?
Yeah. So one thing I'm going to add to that too, I think
Mhm.
there's a huge misconception that a lot of times is a lot more flexible when it comes to debt to income ratio, credit
Mm,
scores, and things like that. A
that's
lot of
good.
people has that misconception that FHA is a bad loan, or it's not as good as a conventional or a VA loan.
Mm,
Sometimes they get a negative kind of like stigma against them, as if like, oh no, we don't want to take any FHA offers, or sometimes even that for VA, they don't want to take a VA offer because their government loans and the credit score requirement is so low that people
mm,
shouldn't accept those offers because the deal might fall apart because they don't have the credit, or they're not putting down any money, or putting down very little money. And that's not necessarily true nowadays. Now, that could have been true, maybe a few years back or something like that. But I would say nowadays, because the market is so competitive, the market is a lot higher and things like that. FHA and VA loans are being used more as a tool to leverage, either qualifying a person for more money or getting around a certain guideline for creative financing. So I think a lot of lenders are kind of using them that way, not necessarily because they quote unquote got bad credit or
Right.
high debt.
right. Right, right. That's good. That's good because I know exactly what you're talking about. When I'm explaining, if I get an offer from a buyer and I'm representing the seller, I explain the type of loan
Yeah.
that the buyer has to the seller so that they understand, okay, with this particular loan, these are some things you might have to um, get over at the end. I think what comes to mind when I think about this is like your FHA loans, your VA loans, your USDA loans, all are good loans, okay? But there are certain restrictions that are in that particular loan when it comes to the appraisal, okay? That have to be met, requirements that have to be met with the property. And if the home doesn't meet that requirement, that appraisal will be what we call subject to, okay?
Mhm.
And I just want to clarify that it's not a bad thing, guys. It's just one of those things that the seller has to consider if some repairs need to be made to the house when it comes to that appraisal. Okay. All right. We can stay all day on that one. But we gonna move on down with those particular loans, guys. Let's talk about down payment, right? Let's talk about down payment.
Hmm.
How much do
Yeah.
buyers actually need for each option that we just talked about? Your VA, your USDA, FHA, all kind of, So go
Yeah,
ahead.
I mean,
Okay. You want to take that, Gab?
to keep it kind of short and simple. Yeah, can you hear me?
Mhm.
Y'all hear me? Oh, okay.
Yes.
Yeah, so to keep that kind of short and simple. Like we already said, FHA is always, it never changes. It's standard 3.5%. Can you put down more on an FHA loan? You can, sure. To finance less. But the minimum down payment is 3.5%.
Mm,
Conventional, like you said, a conventional loan can go as low as 3%. The sometimes the standard may be considered 5% down payment, but depending on your where you fit, your sometimes it can depend on your income um, for that specific county or that area, the range of your income to where you can qualify for a program only putting down 3%, or you may have to put down 5% with a conventional loan.
mm,
Some people will put down as high as 20% or more to eliminate having to carry mortgage insurance with their loan. So it's very popular for people who are putting down a large down payment to strictly go with the conventional loan for those purposes, um, so that they can eliminate the requirement for mortgage insurance. And guys, what I mean, not to get off subject, but what mortgage insurance is? It's an insurance that protects the investor or the lender. So it's like you're paying an insurance premium in the event to avoid the lender being on the hook for you defaulting if you don't pay your mortgage. So that's what that insurance covers. It covers the loan, the mortgage, to protect the lender who has given you this money. In most often it's in the short term. It's within those first 1 to 10 years to where you don't haven't built enough equity. If you were to get foreclosed on or whatever the case may be, But that's what mortgage insurance is. It protects the mortgage on the home, so that it can be, recouped. Um, and yeah, that was my little spiel on that. Um, but conventional loans, 3%, 5%, and like I say, people put as high as 20%. But let's talk about the one that for our veterans and our active duty or retired or displaced. The the VA loan is probably, what we consider one of the better loans, or best loans, because again, there's no down payment. It's zero down payment.
Wow.
Depending on your exemption status, um, allows you to also be exempt from mortgage insurance. There's no mortgage insurance carried on a
Mm,
VA. Yeah, any other in addition to that, I mean, you just very pleased that you don't have to come up with a down payment.
right.
Um, but there are,
Right.
again, there are certain other associations, such as a funding fee and things of that sort, that whether you're exempt from it, you won't pay or you will pay. But that's going in the weeds of that. But to answer your question, those are the differences in terms of the down payment requirements.
Okay. Well, I tell you what, Gavin. When you said that, it made me think about what these attorneys said closing. You talk about mortgage insurance, someone defaulting. Attorneys will say this: if you pay, you stay. If you don't, you won't. Okay.
So
So if you pay, you get to stay. If you don't, you won't get to stay.
yeah,
So but yeah, guys, I mean, it's so good to kind of know that, because a lot of people think, hey, I got to come up with 20% down. That's like the thing they see on Zillow, and that's why you see that lower monthly
right.
payment, and people get
Mhm,
fooled by it. It's like, man, I can get that house. All that is 1,600 a month. Well,
mhm,
no, that's after you put down $40,000,
correct.
or 20%. You
Right.
know, we need to go a little deeper into the calculations and make sure you got the right loan that's in there. With whether it's a 3.5% FHA loan, 3% conventional loan. Also, you got to consider the interest rate as well. So that's how we get to some of those monthly payments. Um, you got anything you want to add to that, LaShawn, or are you good?
I think I'm good on that part, of
Okay.
it.
Okay. All right. So one we didn't talk about, and it's similar to the VA loan, which is the USDA loan. I know that's not on the list,
Yeah.
but that's a cool loan too, if I'm not mistaken. Could y'all touch on that one for a little bit? Tell them
Yeah.
about that one.
So very similar to kind of VA, just you don't have to be, a veteran to get USDA. The requirement for that one is that you have to live what they consider rural. So as the South here in South Carolina, as South Carolina continues to grow, the rural map or guidelines is kind of being stretched out some, because certain areas that was considered rural is now becoming overpopulated, and so soon they won't be considered rural as much. But for the most part, with USDA, you have to be purchasing in a rural area. That particular loan does not require a down payment, so it's 100% financing, which is great. They don't carry mortgage insurance. They have something similar to VA. VA has the funding fee. USDA has something called a guaranteed fee that you
Mm,
have to finance in, but it's lower typically than mortgage insurance. So when it comes to interest rates, when it comes to the mortgage payment and things like that, things tend to be a lot lower on USDA. That's kind of like a little bit more of an incentive to kind of utilize those loans. But I would tell you, in the last couple of years, and I've been doing this now for over 10 years, about 12 years now. Um, I haven't done a USDA loan in forever, just because they have not become as popular anymore.
mm,
Because
mm,
there are income restrictions when it comes to that loan, based on
right.
your household size. And then I know Gavin mentioned earlier, when it comes to like debt to income and things like that, it's a lot lower under those programs. So sometimes you don't get as high of an approval. And with the cost of living, the cost of housing, and things like that all going up, USDA is not as attractive as far as a loan program right now, is what I've been seeing in the last few years. Not too many people have been truly going after USDA, but it
Right.
is still an option. But
Okay. So so we only got a couple seconds left, and I want to hit these last two, okay,
okay,
before we end.
Yeah.
Um, So we've been hearing about FHA, conventional, USDA, you know, AAA, you know what I'm saying? All these
ARP.
kind of loans, right? I don't know if they got an AAA loan, but how does someone know what is the best loan for them? How can someone figure that out? I want to buy a house. How do I figure this out? What is the best loan for me?
Hey, easy one, Mike. First of all, you don't know because you're not educated on what loan is best for you.
You right. You
Simply
right,
put,
Gavin. I'm not.
you may have you may have researched and read a book. That's great, but you didn't go get licensed. You haven't studied this. So the first thing you need to
Right.
do is consult with a lender. Give LaShawn and Gavin a call. Let us take a look at your situation. Let us
Right.
understand what it is that you need to accomplish, and we will advise you on what your best loan option is, and then also let you know what your options are in their fullness. Because yes, FHA may be the best option, but you may have some particulars about how you want things to go for you in the future. And you know what? You just adamant, man, I want to have a conventional loan. Well, we'll provide you your conventional loan options as well. But yeah, man, they just have to be serious about taking the first step to consult with a lender so that we can advise you of the options that you have based on your scenario and situation.
Yeah, I mean that's perfectly said. I mean, at the end of the day, Gavin said it, perfectly. It's not your job to kind of figure out what loan, is the
Mm,
best match for you. That's really the loan officer's job. That's truly what our job is. Our job is to, look at all your credit, look at your income, look at your student loans, look at all your debt, and try to find a loan that kind of match what you have going on, or for
right.
us to create a strategy to kind of get you in the program based on your needs, based on where you want your payment, based on what you want to pay out of pocket versus what you don't want to pay out of pocket, and so forth. Our job is to help find that matchmaker, situation for you.
You took the words out of my mouth. Matchmaker. You guys are the loan matchmakers.
That should be our
I'm
new
the
name.
house
Oh,
matchmaker.
Mhm.
Okay. All right. So Gavin and LaShawn will help you find the loan for you. I will help you find a home for you. Okay.
too
So
rhyming.
all right. Let me end it. Let me end it right there. I don't need to say nothing else. I hope to see you guys next Tuesday for Teach Me Tuesday, and we hope to see you again, guys. Have a great week.
Please. Yeah, I was trying to drop my mic, but it's attached, so I can't drop
Can't
it.
even drop it.